Welcome to Course 17 of the MaxLife Commercial Academy. I'm Ryan Solberg, real estate broker with MaxLife Commercial here in Central Florida. License number 33541. In this course, we're tackling two of the most misunderstood and most exciting asset classes in commercial real estate right now: office and industrial flex. The office market has gone through a generational reset since COVID, and a lot of investors are either avoiding it completely or walking into traps. We're going to show you where the real risk is and where the real opportunity is hiding. On the industrial side, we're in the middle of a supercycle driven by e-commerce, reshoring, and last mile logistics, and there are still ways to get in at attractive yields if you know where to look. Let's get started. Before we go deep on each subtype, let's get our bearings. Office and industrial are both in the commercial real estate bucket, but right now they are telling completely opposite market stories. Office is in a prolonged correction. Vacancy rates nationally are near historic highs, and a lot of Class B and C suburban office parks are functionally obsolete. That doesn't mean you can't make money in office. It means you have to be extremely selective and underwrite differently than you would have 5 years ago. Industrial is the mirror image. Demand has been extraordinary. E-commerce, nearshoring of manufacturing, the build out of EV supply chains, data center adjacency. All of it is driving absorption of industrial space at a pace we've never seen. As you can see on screen, the 6 major subtypes range from bulk distribution mega warehouses all the way down to outdoor storage yards. Each one has a different risk profile, a different tenant base, and a different financing universe. In this course, we'll work through all of them so you can make an informed decision about where you want to deploy capital. The office market post-COVID is not dead, it's bifurcated, and understanding the bifurcation is everything. The danger is in the mushy middle. Class B suburban office parks that were built in the 1980s and 90s that don't have great amenities, that are surrounded by parking lots rather than walkable destinations, and where tenants are downsizing or not renewing at all. When you see a deal where the broker is advertising a 9 or 10 cap on office, your first question should be, what is the weighted average lease term and what is the rollover risk? A high cap rate on office today often means the market is pricing in significant vacancy at rollover. That's not necessarily wrong, but you need to underwrite it honestly. On the opportunity side, medical office has been one of the most durable commercial property types through the entire COVID period. Healthcare doesn't go remote. Government leased office is another safe harbor. GSA leases can run 10 or 20 years. And if you're a sophisticated investor, deep conversion plays, turning office into multifamily or mixed use are real opportunities in markets where housing supply is constrained. Here in Florida, Sunbelt dynamics are helping certain office markets recover faster than the national average. Miami, Orlando, Tampa, and Jacksonville are all seeing net positive corporate relocations. That's a tailwind for well-located Class A product. Let's get precise about industrial subtypes because investors frequently conflate them, and the underwriting is genuinely different for each one. Bulk distribution is the Amazon warehouse model. Massive buildings, single tenants, institutional capital, long leases, very low yields. As an individual investor, you're unlikely to be buying a 1 million square foot fulfillment center, but smaller institutional quality bulk assets in the 200,000 to 400,000 square foot range do trade, and some private equity funds give accredited investors access to this category. Last mile logistics is arguably the most coveted subtype right now because it's the most supply constrained. You cannot manufacture infill land close to population centers. Cities are built out. When a last mile facility becomes available, there are multiple bidders. Cap rates reflect that scarcity. If you can find last mile product in a growing Florida submarket, think Eastern Orange County, Brevard County, along the I-95 corridor, or the I-4 spine, you're likely buying into durable long-term appreciation. Light industrial and flex are where most private investors actually operate, and that's where this course will spend the most time. These are accessible, manageable, cash flowing assets that respond well to active management. We'll go deep on both in the next few slides. Finding the right industrial market is as important as finding the right building. The fundamentals tell you whether you're buying into a market with pricing power or one where you'll be fighting for tenants at rollover. In Florida specifically, a few submarkets have emerged as consistently strong industrial destinations. The I-4 corridor, from Tampa through Orlando to Daytona, remains one of the most active industrial corridors in the Southeast. Lakeland in particular has become a distribution hub because it sits almost exactly halfway between Tampa and Orlando with direct interstate access. The Space Coast, Brevard County, is seeing surging industrial demand driven by aerospace and defense, SpaceX's Starbase presence nearby, and a workforce that's deeply technical. South Florida has the strongest last mile demand, but also some of the tightest supply and highest land costs in the state. The Tampa Bay market is absorbing new industrial supply as fast as developers can deliver it. When you're analyzing a specific market, the checklist you're looking at right now tells you the green flags and red flags. Vacancy below 5%, positive net absorption, and rising asking rents are the three most important indicators. When all three are in your favor, you have a market where landlords have leverage, and that's where you want to own. If I had to pick one industrial subtype for a private investor who wants cash flow, appreciation, and manageable complexity, it would be small bay flex every single time. Here is why. Large institutional buyers, REITs, pension funds, private equity, have enormous minimum check sizes. A 6-unit flex park at $2.4 million is simply too small for most institutional capital to bother with. That means you're competing with other individual investors and smaller regional operators, not Blackstone. You have a genuine competitive advantage in that size bracket. Small Bay Flex also benefits from what I call the stickiness premium. When a local HVAC company has their trucks, their inventory, and their office all in one unit, they are not moving for a small rent increase. The cost and disruption of relocation is enormous. That creates renewal rate leverage for landlords that you simply do not get in office. The active management upside is real and measurable. When we work with investors at MaxLife Commercial, you can reach us at 321-586-2121 or at maxlifedevelopment.com/academy. We frequently identify flex parks that are underperforming because the previous owner was passive. Deferred maintenance, below market leases, high vacancy, these are fixable problems that translate directly into value creation at exit. Industrial outdoor storage, IOS, is the fastest growing niche in all of commercial real estate right now, and most individual investors have barely heard of it. IOS is exactly what it sounds like: paved or gravel surfaced outdoor yards used to store trucks, containers, construction equipment, vehicles, and materials. there is typically a small office or guard shack, perimeter fencing, and lighting. That's it. No roof to maintain, no HVAC to repair, no interior build out. The asset is fundamentally simple, and the demand drivers are extraordinarily durable. As e-commerce requires more trucks and more last mile delivery networks, trucking companies need more yard space. As construction booms in Florida, and it is booming, contractors need more laydown yards. As EV charging infrastructure gets built out, utility companies need equipment staging. Every one of these trends points in the same direction: more demand for outdoor storage yards, especially near highway interchanges in growing metros. Institutional capital figured this out around 2021 and started building platforms to aggregate IOS assets. Companies like Green Acres, Zenith, and several major private equity firms have raised billions specifically to buy IOS portfolios. What that means for you as an individual investor is that if you can buy a well-located IOS site today in a market like Orlando, Tampa, or along the Space Coast, you have a realistic path to selling it into an institutional portfolio at a compressed cap rate, a meaningful exit premium over your entry price. The window to buy before institutional pricing fully arrives in secondary and tertiary Florida markets is still open, but it is narrowing. Financing is where office and industrial diverge most sharply in the current environment, and understanding that divergence will save you from a bad deal. Lenders today are highly differentiated in their appetite for office. Community and regional banks that were aggressive office lenders before 2020 have pulled back dramatically. You will find loan to value requirements of 60 to 65% on suburban office, and some lenders simply won't touch it. If you're pursuing an office acquisition, build your financing plan before you go under contract, not after. Know which lenders in your market are still active in office and what their underwriting parameters look like. The SBA 504 program is a genuine lifeline for owner-occupied office because it allows you to get to 90% loan to value with a below market fixed rate on the SBA portion. If you are a business owner buying your own office building, 504 is almost always the right answer. Industrial financing is a completely different experience. Lenders compete for quality industrial deals. 70 to 75% LTV is standard. Rates are competitive. Terms are favorable. The BRR model: buy, renovate, rent, refinance, repeat works extremely well in light industrial and flex because you can often add significant NOI through lease up and rent increases, refinance at the new stabilized value, pull equity out, and redeploy it into the next deal. At MaxLife Commercial, we help investors structure these transactions from acquisition through disposition. If you want to talk through a specific opportunity, call us at 321-586-21221. We'd love to help you analyze it. That wraps up Course 17, Office and Industrial Flex. You now have a framework for navigating two of the most interesting and divergent asset classes in commercial real estate today. The core message is this: don't let the headlines about office scare you away from the whole sector, and don't let the hype about industrial push you into overpaying. Do the work, underwrite honestly, and focus on the subtypes and markets where your capital has the best risk-adjusted return. If you want to put these concepts to work in the Central Florida market, I'm Ryan Solberg, real estate broker with MaxLife Commercial, license number 33543. Give us a call at 321-586-2121 or visit us at maxlifedevelopment.com Academy, where you can access every course in this series for free. Up next is Course 18, Land and the Development Process, where we'll cover how raw land gets entitled, how developers think about risk and return, and how investors can participate in development deals without becoming a developer themselves. I'll see you there.